Are we going to do a show, or are we just going to groove?
I'm just dancing, man.
All right.
I didn't see the proverbial point. Welcome back to the show that we're going to have now instead of just grooving. I thought we might have just hit some FM tunes here for a little while.
Might as well. Have some fun.
All right. We're back. That was Jason Hadishell talking a lot about buying investment properties. And, investment properties are certainly becoming something that is creeping into people's minds here as the real estate market starts to come back here in Seattle. And mortgage rates, once again, not a broken record, hit all-time lows, like the lowest ever again. It's incredible. And Ryan Leopold is actually back with us from Cobalt Mortgage. Well, welcome back, Ryan.
Thanks for having me, Ben. I appreciate it.
It's good to have you.
Good to be back.
It's good to have you. And man, you were dancing over there more than anybody with that.
Man, Eric is bringing it today. I love it.
Keep bringing it, Eric. You got it, baby.
Oh my God.
Well, so there's a lot of unique ways to finance investment properties. It's not just the same old thing as it used to be. And, Jason and I just talked a little bit about the Fannie Mae properties, the Freddie Mac properties, all those ones that are, essentially bank owned, for lack of a better term, although really they're huge institution owned. And, there's different ways to finance those, aren't there?
Well, I think, listen to Jason, I think a lot of when it comes down to a good deal on investment side and not being a great deal, a lot of the time it comes down to the financing. So if somebody's going to buy and hold, coming up with a mortgage strategy is really a key part of that, of knowing how it's going to cash flow over time, is choosing the right mortgage strategy at the end of the day. So, yeah, I think financing is huge when it comes to building a real estate portfolio of investment properties.
Especially when you start thinking about the portfolio, the actual aspect of making money with your real estate investments, because the financing is like that's half the income or half the problem.
Yeah, that's half the liability.
Half the equation.
Yeah. Absolutely. That's a big part of it. So I think, any good investor who's planning on holding a property for, more than just flipping it needs to really get that mortgage strategy in place almost before they buy a property. So they're kind of really ready for a refinance afterwards. Almost pre-qualified for a refinance if they're going to buy with non-traditional financing.
Yeah, otherwise it can get pretty expensive quick.
Yeah.
Pretty quick. Let's talk about buying some of these properties that are owned by Fannie Mae. Now, we've heard different rumors that maybe there's going to be more coming on the market from Fannie Mae, maybe not. Maybe it's because of the election. Maybe it's because there's not very many out there. There are a lot out there. Who knows? It's all rumors at this point in time. We can't seem to find the right answer. We'll get to the bottom of it someday. But, with properties are owned by Fannie Mae, there's different ways to buy these, different financing techniques. Tell us a little bit about them.
Yeah, so I think it's important that buyers understand, and Jason brought it up a little bit as well, is understanding that bank-owned properties, said by major financial institutions, can not only be owned by Bank of America, or Wells Fargo, or Chase, but a lot of them are owned by Fannie Mae and Freddie Mac. And they've now gone through the foreclosure process, and they now own these properties. And to get rid of them, a strategy they came up with is actually offering unique financing programs to buyers, not only investors, but to first-time home buyers as well, or people looking to buy a property as a primary residence. And there's a lot of unique twists and turns about the programs they offer that make it really kind of intriguing to a first-time home buyer and or an investor.
What are some of those intriguing things?
So first, if you're looking to buy a house, and Jason mentioned that first look period. So the first time a new Fannie Mae property comes on the market, home buyer who's going to use the property as a primary residence can buy it with 3% as a down payment. So that's a big one.
Number two, less than FHA.
Which is less than FHA. But number two, you can buy it with no mortgage insurance. So you can have 3% down, no upfront mortgage insurance like FHA, and no monthly mortgage insurance like FHA. So that's a pretty big deal. Number three is you can do it without an appraisal. So a lot of these issues that some homes have, not having to get an appraisal and not meet traditional underwriting guidelines when it comes to the quality of the property, those are waived because not only the cost is waived, but also the irritation of having to bring him up to code before he close is gone as well. So that's a great opportunity for a buyer to come in and buy one of these properties as a home buyer who's going to live in the home and really get great terms and conditions that are programs that aren't offered anywhere else other than Fannie Mae homes.
And is this a kind of Fannie Mae owns it, so basically they're having somebody else get a Fannie Mae loan, but at least somebody's paying the mortgage at this point in time.
Yeah, pretty much. I mean, they own the property, so they're just looking to turn around and get it off their books in a way. and actually get somebody to pay money into that house and actually find a creative and unique way to draw buyers in.
What if that property isn't perfect? What if, there's FHA has the, you're going to go renovate it, the 203K that, people talk about. That it's actually a great program. It's a little sticky. It's got some hoops to jump through. Does Fannie Mae offer? They offer something similar.
It's similar, but actually a lot better. So the FHA 203K loan is great, and in theory, it has a lot of benefits. But once you get into it and actually go through the numbers and the process to get one of those and to get the $20,000 or $30,000 to put into the property. So how FHA works is you can actually finance in some of the remodel costs or some of the what do they call it? Cosmetic type improvements that need to be done in a home before you actually move in. But FHA 203K is really not easy, and it's not really a fun loan to do, so they're not done very often at all. HomePath has a different twist on it where they have a renovation side where a lot of these properties that they've gone through foreclosure have kind of been beaten up quite a bit. So a lot of them need a lot of work. So if it's tagged as a renovation property, you can actually finance in $30,000 to $50,000 worth of work into the end loan amount to actually improve the property and make it livable for an investment property or for a primary residence. So renovation is just an easier way to go via the HomePath process.
And then that puts you in a position where you can actually buy the house or at least live in the house that you want to live in. You make it nice and customize it a little bit.
Yeah. So again, you can use 3% as a down payment, have no mortgage insurance, do not need an appraisal, and then you can finance in all the work that needs to be done to the property. So if you're financing in all this work, in theory, you're making it a better home that's worth a little bit more, and all you're doing is putting financing into the loan and 3% and 4% range. So it's really a really great deal if you can find the right property.
Yeah, and with rates where they are, it's just incredible.
It's crazy. It's really good. And
it's
actually,
cheaper than the Home Depot credit card, though, to go finance it, even if you wait over 12 months or whatever they give you.
I think what's interesting is that program is not utilized as often as I think it should. But with a caveat, once you get in there and everybody's going to be a little bit different, once you understand everyone's unique positions, a lot of times, even though they qualify for these loan programs, it may not be the best loan program for them over time because there's always the good and bad about every loan program that's out there, without a doubt.
What are some of the things that maybe wouldn't make this something that somebody would want?
Yeah, I'd say first it's going to be you can only buy Fannie Mae backed homes. So you can't use this program to buy a traditional listing or a Bank of America bank-owned property. The loan has to be owned by Fannie Mae. So there's only a certain amount of properties out there that are Fannie Mae owned. Okay, that's first and foremost. And I think second, once you get into it, the cost, even though you don't have mortgage insurance and even though you only have 3% down, sometimes the cost of the add-ons to interest rate aren't worth the benefit of 3% down and worth the benefit of no MI.
So you actually end up with slightly higher interest rates sometimes. So if it's your way to get into the property, great, but it may be something you want to refinance out of once you fix it up.
Yeah, I think it's a case-by-case basis for everybody. I have clients coming in sometimes and say, I want a Fannie Mae property and I want to do HomePath, and then they get frustrated that they want this perfect house, but they also want a property that's owned by Fannie Mae. It doesn't quite work like that. You kind of are subject to what properties are available for the consumer. And if it's the right fit, maybe that loan program's great, but sometimes the cost can be too high.
Jason was talking about investments before, just a few minutes ago. How does this program work for investors?
Yeah, that's unique too. So on the investment side, you can go in with 10% down, again, with no mortgage insurance and no appraisal, and you can have up to 10 finance properties through this program. So if you're an investor looking to build a portfolio of buy and hold properties, you can go out and buy 3 to 10 properties, all financed under HomePath, and maybe throw some renovation in there as well. And, actually buy a portfolio of properties with not the traditional 20 to 30% down that most investment properties require. So again, it's another strategy. It's another tool that investor can utilize if it's the best thing for them in their portfolio moving forward.
We're here with Ryan Leopold of Cobalt Mortgage. Ryan, a few minutes left before we have to go to break. But so this HomePath, you go out and basically it sounds like the toughest part isn't necessarily getting the financing. It's making sure the house fits the bill and what you're trying to purchase. I'm sure Jason can give us a little bit more insight on that here in a little bit. But when people come and they ask specifically for these type of programs, it kind of puts you in a tough position, right? Because a lot of people, and I hear this too, well, I want a loan modification. Well, you actually want, you want to refinance your loan. It's not really a loan modification. And I think people can come to somebody in any profession, whether it's mortgage or finance or whatnot, and people will tend to think because they heard a snippet of information somewhere that this is what they now want.
I think it sticks with your overall theme of this show is get consumers in front of true professionals. So I think that all these loan programs, whether it's HomePath, whether it's should I buy an investment property or not, whether it's some of the state bond programs that are out there, down payment assistant programs, I think it's you have to understand the overall theme of what a consumer is trying to accomplish. And in some cases, these loan programs may be the best for them. But in some cases, and actually most cases, they're not. So I think to come in and say, I want to buy a new home and I want a Fannie Mae property so I can put 3% down and take advantage of the HomePath program, but yet I want a 3,000 square foot house with a big yard, new construction in Woodinville under this neighborhood in this school district. It doesn't really work like that. So I think it's just being open to all the options that are available and start kind of whittling it down to the one that's the best fit for you. And it may include some of these programs and it may not.
Well, sometimes the house is the bigger deal than the loan program.
I think when you're talking about interest rates as low as they are, and even though there's a lot of competition out there, I think at the end of the day, it comes down to the right fit because, it's tough to get houses. Jason mentioned 20 offers in some places. Whether you're an investor, first-time home buyer, move-up buyer, I think you just have to be realistic and set a reasonable plan to achieve your objectives.
I hear you. Well, Ryan, thanks so much for joining us. We do have to go to break. Jason's going to come back and join us. We'll talk a little bit more about Fannie Mae, HomePath, finding that right property, and ultimately making sure that people are making sound investments when they are financing and buying homes. That's Ryan Leopold of Cobalt Mortgage. I'm Ben Brashen. We'll be right back after this break.